Please stay tuned after the conclusion of the podcast for additional important information. Hey everybody, welcome to another episode of Accrued Interest, PIMCO's podcast dedicated to serving financial advisors and their clients. As always, I'm your host, Greg Hall. I lead the wealth management business for PIMCO here in the United States. Today, I'm excited to be joined by frequent flyers, returning champions, popular guests backed by popular demand. Marc Seidner, our CIO for non-traditional strategies, and Pramol Dhawan, who leads our emerging market investment business. Hi, guys. Welcome.
Hey, thanks for having us.
Hey, Greg. Thanks for bringing us together again. It's always fun.
It's good to have you back. We listeners will remember, I hope, that we try to feature you guys at least 4 times a year talking about a piece that you write called PIMCO Perspectives, which is published quarterly, hence the 4 times a year, and where you try to take a little bit of a zoom out view on what's going on in markets. It may or may not be directly related to what we publish in our Outlook pieces or what's going on kind of the day of, but you get a chance to sort of ruminate on what's going on out there. And the latest piece, which was published just a little while ago, is entitled "When Geopolitics Becomes an Economic Input." I'm sorry to say that my fears that title would become dated by the time we did this podcast have not come to pass, and the situation in the Strait of Hormuz remains tense. So maybe Pramol, just walk us through kind of the lens, the thesis behind the most recent piece.
Thanks very much, Greg. We've been seeing more and more regime-changing headlines, particularly this first quarter in 2026, than most of us have been accustomed to in a full economic cycle. So this sort of note was an extension of previous messages that we've been delivering around the fragmentation eras, and really what's changed here is just the pace. The thesis is playing out faster and more broadly than even we had anticipated. And the core idea here is that surprise is now the new baseline. It's not the exception anymore. That fragmentation should not be a forecast. It's an observable reality across trade, fiscal policy, and economic alliances. And when we sort of think about that, we sort of think that the old framework, which was around open markets, shared norms, predictable institutions, that's under genuine threat and genuine stress. And accordingly, the frameworks that one puts and places dear in the old norms can become outdated very quickly. So it's really a call to action to start to rethink and to widen one's aperture.
Yeah, we've mentioned that. You've mentioned that the last time we spoke, we talked about that. It was, I think, Marc, remind me, keep me honest here, but I think it was our 2025 Outlook piece was the fragmentation era that Pramol just referenced there. Core thesis sort of being that, in the modern era or the current era of politics, certainly influenced heavily by the current administration, we cannot rely as much as we used to on norms and common practices, free trade, global unity, that there's just going to be, a little bit of a breakdown in that pattern. And I guess the question for today is how do we place the Iran conflict into that, I was going to say framework, but I suppose lack of framework. Mm-hmm.
Well, I think it has to be part of the framework, right? I mean, historically, as Pramol sort of alluded to, geopolitics, particularly for most of the Cold War period, sort of functioned in the background, and episodic moments, but it really has become a first order economic variable, and that's exactly how you place the current Iran conflict and concerns in the Middle East. I mean, one has to look at energy dependency or independency. One has to look at supply shocks, supply chains, resilience around the globe. Look for areas of differentiation and build it into one's analysis of the outlook, because I think as a result of all of this, geopolitics now belongs alongside growth, inflation, and monetary policy as part of the core economic analysis. And I think that the Iran conflict does absolutely nothing but reinforce that view and continue to elevate the importance. I think Pramol and I probably got high praise from Rich Clarida, and it's nice when you get high praise from Rich Clarida. He grabbed me when I was in the New York office last week and said, "I love your piece. Love your piece. We have our secular forum," and you talked about the fragmentation era being the theme of our secular forum output from 2025. We'll see what we coalesce around in 2026, but I am sure that this will be a topic for much discussion, hot debate. And hopefully coalescing around conclusions when we all gather together next week to think about the next 3 to 5 year outlook.
Let me just jump in for listeners who may not already know. Rich Clarida is PIMCO's global economic advisor. He was a vice chair of the Fed for many years, is a professor at Columbia University, and amongst his other responsibilities, advising our investment committee and helping us think through day-to-day investment issues. Rich runs what we call our secular forum, and that's what Marc's referring to. We all gather in Newport Beach next week, and literally from the youngest associate on the team to the most senior veteran portfolio manager, everybody gets input, everybody has a point of view, everybody gets to debate, and usually some interesting things come out of it. So having said that the Iran conflict sort of fits within the expect the unexpected umbrella here, how are we thinking about that conflict at this point? What's the debate inside the investment committee today about where things stand, how likely they are to persist? How would you gauge the risk to markets from here on out, knowing, of course, that these are maybe base case scenarios, and we consider the tails as well.
Yeah, maybe I can just start on that one and just say that, look, the honest answer is that nobody knows on the timing of when this crisis is going to be over, and anyone claiming precision is sort of selling something that is inherently a falsehood. But look, we think from an investment committee, scenario framing is far more important than point forecasts and point estimates. And we're sort of not in the business of calling the day that the conflict ends, but we are in the business of making sure that portfolios don't require us to do so. And when we think about various different scenarios, we think about containment and de-escalation in which oil retraces, rates will rally, risk assets will stabilize. And then we think about escalation and supply disruption in which you may have stagflationary impulses and central banks become somewhat in a bind. And we try to place probabilities around them based on new information. We also take a look at just the underpinnings of the markets and say, gosh, for an oil shock like this, the underlying PMIs have been inherently stable and have trended on an uptrend, which is very dissimilar to the 1970s oil price shock. And when we sort of think about that, we think that there are some competing forces which are allowing the US economy to keep trundling on, the global economy to keep trundling on. AI capex expenditure and the widening out of that is sort of chief amongst those. But also sort of tariff rebates have been very, very important. Fiscal spending, particularly in Europe, as it pertains to defense spending, has also sort of been very important. And we sort of think to ourselves, gosh, we came into this year, and Marc will know better, with a pretty constructive growth outlook and a sort of slightly benign inflation outlook, and we're sort of shaving a little bit off the growth and a little bit more on inflation. But if and when the dust settles, I think Marc and I both think it's a pretty good backdrop for risk assets.
That is, yeah. I was going to say, Marc, markets seem to have been remarkably resilient. We've ventured into discussions of equity valuations in this segment of the podcast in the past, so maybe I'll ask you to do so again. But why, to continue on Promol's point, why have markets held up as well as they have? And then I was going to ask also, do you see a difference in how the stock markets and the bond markets are reacting to what's going on?
Yeah, I mean, I think a couple of things, Greg, and I think part of the way markets are responding to this event or this, moment of uncertainty or an unexpected, input. Part of the reason we wrote this piece is it's a reminder that, we have to think about this on a forward-looking basis rather than just go back to the historic playbook. In early March, after the initial conflict, the market immediately went back to a narrative that geopolitical conflict in the Middle East with a supply disruption on the energy markets and ensuing volatility in the energy markets is equivalent to or harkens back to the 2022 invasion by Russia of Ukraine. And our analysis would say that, well, yeah, that's a nice starting point, but let's look forward. This is very different, right? In 2022, we had a supply disruption in energy markets as a result of Russia's aggressions. But we also had a demand shock coming out of COVID with pent-up demand for all kinds of stuff, initially goods, then services, that was supported by massive fiscal and monetary stimulus, not just in the United States, but around the world, but certainly centered in the United States. And that created that inflationary narrative. Here, it's obviously very different. We have the supply shock, but the demand side of the equation is very, very different. And this is we'll actually debate this in our investment committee this week because the outlook our outlook is one of expect demand destruction because of the rise in energy prices. Labor markets are not nearly as robust as they were in 2022. Real wages are stagnating for most of the economy. We're in this no hire, no fire moment for labor markets. Mm-hmm. Fiscal policy, while being supportive in the United States from one big beautiful bill, becomes restrictive or not supportive in the second half of this year around the world. And so when we look at the potential stagflationary outcome from this geopolitical event, this moment, it's very different than the most recent historical narrative, and you really have to put a forward-looking lens on it to think about the impact for financial markets. And maybe I'll just tease this out, and you can ask us both to dig deeper in it. But our assessment, and I think anybody's assessment, would be that markets' response over the last 8 weeks is very, very different in terms of pricing. Impact both on the growth element and the inflation part of the equation. Equity markets making new record highs, credit spreads back to historic tights, while the front end of yield curves and the levels of interest rates are pricing in a very, very, very different scenario. So it's almost as if risk assets, as I think Pramol said, have already looked through this event to resolution versus fixed income or sort of central bank policy expectations, expecting much more meaningful implications, and perhaps both can be right. But I think we've learned in the past that when markets are pricing in different outcomes, that is a key opportunity for active management, for repositioning, for deployment of capital, and an opportunity to engage with investors, advisors, clients on some of the implications.
It does seem like the crux of the disconnect, though, is this growth outlook. And Pramol mentioned, some reasons to have been optimistic at the start of the year. Marc, you just mentioned how some of those reasons might ebb over the balance of the year. And then I guess the unknown is to what extent high energy prices begin to change behavior and kind of kick into eroding growth. How are we thinking about that balance right now between kind of the ongoing look through the volatility and have a more Goldilocks outlook versus the potential for a recession in the not distant future?
Recession probabilities have definitely gone up. We have downgraded, growth has been slowing sequentially, right? 2024 was upper twos, real growth in the United States. 2025 was mid twos. Our initial forecast, as Pramol had sort of alluded to, was sort of lower twos for 2026 growth. We're now probably mid-ish to upper twos in terms of the growth outlook. And while inflation expectations, particularly core, we don't see the second round pass-throughs because of weakness in labor markets and demand destruction. We don't see as much pass-through in inflation as we do see deterioration in growth. And so, if we probably marked up our inflation expectations by 2 or 0.3% and marked down our growth expectations by 5 or 0.6%. And so I think that gives you some sense of the direction of travel and order of magnitude. And I don't know what I'd be curious what Pramol's probabilities are, but recession probabilities are certainly going up. I mean, second quarter GDP or the first quarter GDP report was quite telling in the sense that once again, outside of technology, there is very little growth dynamic in the economy, and so we still have this very bifurcated set of circumstances when there is one behemoth sector that continues to drive the lion's share of growth, while the rest of the economy is largely stagnating, and it certainly feels as if this is a moment or event of increased uncertainty that will, sort of freeze the system and have, negative economic consequences. So, sort of summarize, I worry, and I think Pramol would probably join me. So we would worry more about the stag than the flation, although it might be sequential. Like we might get the flation before we get the stag, but I worry, for the balance of 2026, much more about the stag than the flation.
I also think this gets to one of our central points in the piece and in previous pieces, this notion around dispersion being far more important than beta. Trying to predict the sort of tipping point on the US economy has proven to be very difficult for many cycles, specifically because of the sizable fiscal stimulus that we have, and trying to predict when that fiscal momentum sorts to deteriorate in the economy. I think sort of from an investment committee perspective, the global opportunity set means you don't have to be that precise. You can find high quality bonds that out yield that of the US in Australia and in parts of the emerging market world, which can help together with a US Treasury portfolio build a ballast for duration. You can find equity sensitive assets, credit assets in Asia, which allow you to play the AI capex expansion just at a 30, 40, 50% discount to US equities that are not as fully valued. So that you can play both states of the world and not be forced into a sort of precision on a tipping point. And I think that's really what's changed this time around versus previous states, where I think you placed a lot more emphasis on that question on the stag versus the deflation.
Yeah. Sorry, go ahead, Marc.
No, I was going to say, and sorry, I mean, there's so much to talk about here that we keep going back and forth.
No, it's good. It's good.
We should let you do your job and prompt us. But
sometimes my job is just sitting here listening to you guys say smart things, so it's good.
I was asked a question by our CEO Manny Roman at a dinner last night, and he was asking about NVIDIA, which is now a close to $5 trillion market cap company that has forward PE looking to next year's earnings of 24 or 25, and to compare and contrast that with some of the infrastructure support around data centers and some of the lending that we have been doing there, and a recent transaction would look something like a 9-year final a 9-year average life, a 19-year final maturity, and a 7.5% fixed rate coupon to an investment grade borrower backed by leases, collateral, and amortization schedule, all the things that are incredibly healthy for bondholders or supportive for bondholders. And when thinking about that question or answering that question, it just seemed quite obvious to me that you'd almost much rather have the high quality 7.5% fixed rate coupon that, when compounded over a period of many years, turns into a 1.5 to 2.5 times multiple, again, depending on the amortization schedule, versus a 4% earnings yield. And so I think that's an example of the type of opportunities that exist for relative value, not just within a market, but across markets based upon what's being priced in today.
Yeah, I'm really glad both of you just made really important points, I think, for the balance of the conversation. I think, Pramol, I was going to thank you for, we do get caught up in the betas and we do get caught up in the binary. And I have conversations with lots of advisors, you guys do too, where we very quickly find ourselves in a conversation of what's the Fed going to do next week with the rate, or where's the 10-year going to be in 12 months? And rarely in these conversations with you guys, or, when we sit back and talk about what's going on in portfolios, does performance really hinge on anything so binary as that? And it's a good reminder. And then Marc, I think you've just sort of brought us back to the role that portfolio construction plays in a lot of these decisions, just knowing we're not going to be right about all these things. I think, for most advisors, you're right. It's not an either or, right? You've got to be exposed to the growth. You've got to be exposed to the exciting part of the economy, but maybe with valuations where they are and the economy growing in a way that is maybe a little counterintuitive given what's going on in the world, you want to be thinking about, finding other sources of return that are a little less risky than what you've got. The other thing that you bring up in the piece, that it sometimes when we talk about active versus passive, it feels a little self-dealing given how strongly we believe in active management. But, one of the things you two think the old way of the world got us very comfortable with was passive investing. That a world where geopolitics was highly predictable rewarded passive investing. And we should be cautious about that unwinding in a world where geopolitics is less predictable. Maybe we can spend a couple of minutes on that.
Yeah, I think there is a state of the world where passive investing makes sense. Usually that's when dispersion is low, when stocks and bonds are mean reverting, when geopolitical volatility is low and predictability is high. The crux of this piece and many other pieces that Marc and I have been writing that preceded this is that environment may be structurally behind us. In a fragmentation world, dispersion widens, dispersion between countries, sectors, companies, it all widens. And passive has no defense mechanism. When the shock comes, it fully absorbs that shock. Mm-hmm. The index owns the winners and losers equally. And active management is built precisely for this state of the world. It is a tool for separating out winners and losers. So look, I don't want to sit here and sort of unabatedly bash passive investing. There is a brilliant solution to a specific problem. The question we all have to ask ourselves is that problem still in this current state of the world? And we think that we've moved into a new regime, one of higher dispersion, one of less predictable policy, less mean reverting markets. And I think that is a world in which benefits active management.
Mm-hmm. Couldn't agree more. And I think if I just listen to everything that Pramol just said, which was spot on, passive rewards what has worked. Active, when done well, should reward what will work, or what can work, or what should work. And that's I think that's the break. I mean, if advisors want to engage in this discussion, would love to do so, because it's a critically important discussion. We put the piece out. We could be wrong. I mean, somebody could say to us, "Well, geopolitics is you're caught up in the firestorm of today, but it'll die down. It'll once again become sort of this idiosyncratic risk that that functions in the background and shouldn't be an input." But if you believe that's an input, and again, if you believe that passive rewards what has worked and active rewards what will work, then it's critical. And even you think about the environment today, we should be looking for assets that are scarce, that have positive convexity or positively exposed to uncertainty or volatility, that have a real element, right? Real assets, and we should talk about this because this is important given how markets have performed even over the past few weeks or even over the past few years, and where there's implicit or potential policy support, and those are all forward-looking concepts, not backward-looking, and that I think in conjunction with everything that Pramol said is exactly the framework to think about it.
Yeah, you mentioned a focus on real assets. Do you guys want to spend a little time talking about insulating portfolios from the Marc, to use your newly coined phrase, the flation. Not the stag, but the flation.
The flation, not the stag. Yeah. I mean, I can start there. I mean, again, it's maybe it's as simple as just looking at the last few years and recognizing that commodities and broader real assets are probably grossly underheld in the individual's portfolio, and again that makes sense, right? It is the financial part of the economy that has done extraordinarily well in the post, even going back almost 20 years to the post global financial crisis period. I was looking at a chart today that was fascinating. The rolling 3-year correlations between stocks and commodities has been positive over the last few years, or even the last 10 or 15 years, and just now it has. And again, it's a rolling 3-year correlation, so it moves slowly. Just now, it is turned negative, and so as we look for diversifiers, and by the way, people ask about the stock bond correlation that has been elevated over the past few years, given the experience of 2022 and 2023. We think ultimately stock bond correlations return to their more normal historical relationship of true diversification, and we think that's absolutely true, particularly if we do get more of the stag than the flation. But if you want to protect your portfolio about two sides of the distribution, and look to where there might be an elevated risk premia given sort of uncertainty surrounding geopolitics and perhaps geopolitics as an economic input, then a little bit more exposure to commodities would probably benefit advisors and their clients going forward. And we in the fixed income world would say inflation protected bonds, the starting point of real yields is pretty attractive, and you get the inflation hedge. So there's plenty of tools that advisors can look at on behalf of themselves and their clients to try to diversify portfolios even further and add some protection against geopolitics becoming an economic input.
And maybe I can just add, I've been on the road quite a bit recently in London for our macro conference, in Japan last week. And whether it's speaking to corporate treasurers, to heads of state or portfolio managers, the same theme keeps coming up over and over again. And I'd like to try and articulate that for our advisors. That's a theme about resilience over efficiency. For corporate treasurers, that means that you've had the fourth supply shock in 5 years. At a certain point, there's no longer a shock to keep having these supply shocks. So you need to build resilience in your supply chains. For heads of state in the UK in particular, my home country, we've had another massive energy transition and shock. It wasn't 5 years ago when the UK got most of its natural gas from Russia and then had to shift to Qatar LNG and now faced that being closed off as well. So resilience around energy independence, resilience around military and military procurement, military independence. And of course for portfolios, when you speak to portfolio managers, PIMCO and in the broader industry, most people are trying to build portfolios that are resilient to various states of the world. And I think it's with that, I would just say that, the key points that we're trying to sort of reflect in portfolios, we've already spoken about active over passive. I think that one is relatively uncontroversial. I think keeping liquidity is important. Dislocations are going to keep coming, and you want to have dry powder to be able to add to them when they do. I think it's also important to reduce concentrations in anything that requires specific macro outcomes to work. This notion of not being sort of point specific and trying to build portfolios in different states of the world is very important. Marc and I certainly believe that geographic diversification is underutilized, that there are high real yields in many markets outside of the US, and we want to be able to go global in this world. Look, we believe that bonds are doing their jobs again, and Marc very, very nicely pointed out to this notion that a high quality fixed income portfolio can out-yield by quite a lot the earnings yields of equity markets, and using high quality fixed income as a genuine diversifier now is really important. It's not a return drag anymore. It's additive. And then finally, I would just say and echo a point that our CIO Dan Iverson has consistently said, which is not to stretch for yield in credit markets. I think that's very, very important in this state of the world where credits return back to pre-crisis valuations, not to just keep going out of the concentric circles and underwriting poor covenants. The cushion's just not there at current spreads. But look, we believe for the first time in many years, you're being paid to be patient in bonds. That's a different world to the worlds that we've been accustomed to previously. And investors can sort of sit tight, they can preserve optionality, and they can be paid a coupon in a high quality fixed income.
Well, I was going to ask about portfolio construction, but I think you pretty much covered it off. I think what I hear the two of you saying is, clearly against a backdrop of we don't know exactly what's going to happen next. A lot of the forces we identified at the outset of the year are still in play. We have a U.S. economy that had some, it had some juice coming into this year that ebbs over the back half of the year. You've got higher energy prices that could create a drag on growth. You've got a labor market that's a little bit of a question mark. Obviously, an unbalanced economy, as Marc said, with tech really being 100% of the growth impulse that we're seeing. And over the course of the last 8 weeks, you've seen rates, it hasn't been a massive reaction. I think they started the year at 4.20 on the 10-year in the U.S. and maybe today 4.40 or 4.38. So in the context of everything that's going on, certainly a contained reaction, but offering more value to investors coming in today. I just offer to you guys what I see in the marketplace, and as we look at our own flows and industry flows, I think advisors generally doing exactly what they ought to be doing. I mean, we might argue with the magnitude of how much fixed income they're buying, but the direction has been adding to fixed income, adding to active versus passive, although in moments of big stress, passive tends to get a win behind it, but then that reverts back. And so I've seen a lot of just really strong, reasonable behavior from advisors. I think your message today can maybe underscore what they've been doing, hopefully give them a little more confidence in pursuing that path on behalf of their clients. I just wanted to mention to those listening, so I was prepping for the podcast today, realized I was doing so in a notebook that is emblazoned on the front, Seidner Department of Finance from Boston College. And Marc, I just give us a minute or two on your relationship to BC and what you've done there, because that was a nice moment for me to see it so tangibly in front of me on the desk.
Well, it's kind of you to mention it, Greg. I mean, I think we all have a need or should feel a need to give back in some way or form to what has made us successful and given us opportunities, and Boston College took a chance on me by accepting me when I think 1984 I started. My daughter went to BC. It's an institution that's near and dear to our hearts. And importantly, finance has been a discipline or a career choice. My time at PIMCO certainly that has, I think, rewarded from my BC experience, and so having the chance to name the department was a way to give back and to pay back and pay forward. Pay back in the sense of the opportunity that was given to me, and pay forward in the sense of scholarship, academics, endowment, and opportunities for the next generation are critically important, and so it's sort of an honor to have our name on it. And I hope you use the notebook, and if you want a case of them, I'm sure I can get you a few more.
Yeah, I think it's a terrific honor for you and the university, and it's always exciting. I'm on college tours with my older daughter now, and it's always exciting to see a PIMCO name on the side of an economic classroom or building. It definitely demonstrates the connection that I think we all aspire to being close to the academic centers as well as markets. But thank you both for being here. Thanks as always for joining us as often as you do, and we'll look forward to the next piece.
We appreciate it, Greg. Thanks.
Thanks, Greg. Always fun.
All right. Well, that does it for today, everybody. Thank you so much for listening and spending this time with us. We know that you are busy. You're running around, seeing clients, helping them interpret the world around them. So the fact that you take some time on the drive or on the subway or however you happen to get around, we really appreciate you listening with us. If you found anything interesting and you want to dive a little bit further, certainly if you want to read the piece we referred to today, PIMCO Perspectives, when geopolitics becomes an economic input, please visit us at pimco.com in the US or your local website, wherever you may happen to be listening. If you identify yourself as a financial advisor, you'll be taken to Advisor Forum. Advisor Forum is our one-stop shop for you to get what you want from PIMCO as quickly and efficiently as possible, and then move on to those important client conversations we know that you're having. Do take a moment, if you haven't already, to like us and subscribe. It really helps us deliver you great content if we know you're out there. Good luck in the markets, and we'll talk to you next time.
The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal pages/podcast disclosures.